prospects going forward that the market seems to be doing by itself now?
Well, at the moment we're seeing house prices going in one direction and household credit, new loans going in another direction, and that won't continue. It's got to come together in some way. So if we were to see not much new lending going on, then any housing recovery would be very credit constrained. Don't necessarily think that's happening yet, but that's something for us to look at. That would be a bit different if we were to see that. We haven't seen that recently. We expect to see house price increase slow down as more houses get built and more people start putting their houses back on the market, and that deals with the real demand which is there. There's an additional question of how that feeds through into consumption, which is also a complex one, but we'll just have to keep watching that.
Okay.
And with the US dollar stuff, you said that the drivers are different now, and if you have a look at the, last time I think we talked about how the New Zealand dollar was in a basket of sort of other commodity dollars that had grown. When you look at us on sort of page 9, figure 0.3.6, we're at the bottom of the growth now, with some of the commodity ones are still at the top. Is there something going on about the New Zealand dollar that's different from now the commodity producer ones at the moment?
Well, those move around a bit, and there's a bit more of an understanding in the international marketplace that New Zealand is not Australia, and the exchange rates could move a little more independently. The Kiwi's been softening a bit as a result of that. I don't know if you'd say there's been a particular driver of that.
No, I think just what Allan said. I mean, some people initially would drive up 6 months was that Australia's been very strong in the international markets to see New Zealand being the same as Australia, but the government's been at pains that our commodity basket is different. Metal prices have been going up, and dairy prices have gone up, but a lot of winemakers, whatever they are making is, and that's been recognised that we're different, and that's why we're slightly lower than that other commodity baskets. But you can see Canada's down there as well.
Okay. Aaron Gilmore, good question.
Yeah, I'll talk a bit about, you forecast a bit of a change and improvement in the economy generally, which is obviously positive news, but there's an interesting mix going on. I mean, you're looking at a slightly lower export growth and a slightly higher investment in, particularly in housing, for example. I think 2010, 2011, you're looking at a 24% increase, which is quite a big chunk in a one-off sort of type scenario. But equally with the export thing, you're talking very high commodity price paths still. So are you expecting actual volumes to go down? Because that's the only thing that seems to make sense with it. Commodity prices staying very high, the economy going faster, but the actual export growth tailing off a bit.
Could I ask Dean Ford, who's head of forecasting, and sorry I didn't reintroduce John McDermott, head of economics, if he can answer that?
Yeah, so the export volumes are predicted to go up.
Right.
There's a few reasons for that, thinking through the different categories. Part of it is just recovery. So, for example, the tourism industry and the manufacturing industry, their exports are very, very low at the minute.
Yep.
And you'd expect that even with the stabilisation of the world, you'd get some recovery. It's not a particularly strong picture for tourism or manufacturing, but you just get recovery because things are so low at the moment.
Okay, so that export growth though, with that big high commodity price, and you're expecting that to remain over the medium term for the next 2 or 3 years, and it's quite a dramatic move than it has been the last year or so. Are you expecting a change in the export mix as a result, from what you just said?
You would expect that.
You're looking at 2 or 3% export growth, but you're looking at 3.5% to 4% GDP growth. So obviously the proportion of the tradable sector is going down relative to the rest of the economy. The rest of the economy is going up.
Sorry, I thought you meant within the export sector. But yeah, exports relative to the rest of the economy are suffering from the high exchange rate. But there's quite a big benefit from higher export prices as well.
Sure.
I think in net you're still getting a reasonable contribution from net exports, but I think we have a line in the statement that says the increase in the currency is largely offsetting the gains in the world and the gains from higher export prices. So you're still getting growth, but...
Okay.
Just one more question, more about the stuff that Mr. Foss talked about, the yield curve. We're seeing a move from a flat yield curve to a normal shaped yield curve. And I'm interested in maybe some of the reasons why you think those things are occurring.
Simon, can you answer that?
Well, without wanting to repeat myself, the cost of term money is more. So previously the banks were very happy to offer people a 5-year mortgage because the cost of them borrowing, and they didn't borrow much, one of the things for financial stability, they funded themselves probably a little bit short, and it was costing them very little over the bill rate. Now we're saying if you're going to offer this term lending, you need to borrow it, and the cost of that money globally in the international capital markets has gone from practically 0.25% to over 2%, and even now close to 1.75.
Okay, so you see that remaining in place for the medium to long term, that move to more of a normal yield curve?
Yes.
Okay. Thank you. Russell Norman.
Thank you, Mr Chair. Perhaps, I think one of the more alarming parts of the report, even though on the one hand you're saying everything's getting nicer, actually the alarming part is what you talk about, the current account deficit. The fact that we have this deficit, we're building up net liabilities, and that over time we're going to keep building up more, which will mean that actually we may be paying a higher risk premium on the more borrowings we have to take to cover that current account deficit. I mean, how does this kind of thing play out? I mean, we are now, after Iceland, kind of next in the queue within the OECD in terms of net liability position. It seems to me an extremely risky position for New Zealand to find itself.
I don't think it's necessarily that risky. We think we're heaps different from Iceland, and it's been interesting to see the flurry of market concerns about sovereign risk over the last few days. And countries like Greece, Spain last night, even concern last night in the markets about the latest British numbers for on their deficits and borrowing requirements, and the Irish budget coming out today. I don't think New Zealand is in that class at all. We think finances are in much better condition, but it's absolutely true to say that the current account deficit is quite significant, and it takes a lot to turn it around. And simply a softer New Zealand dollar on its own would take a long time for it to have a response, more so than, say, the Americans have with their current account deficit and their soft US dollar, because we've got a much bigger net investment income deficit. So it's not just the traded side, it's the investment income side that's a big driver of that.
I mean, in some ways the recession has helped because the sending the profits back to the overseas owned companies has dropped off.
Well, it depends on profitability in New Zealand compared to overseas, as well as the different volumes involved. But of course, the crisis has knocked down imports here, as it has in a whole lot of countries, hugely, but that's a short-term sort of thing. We're looking for what the medium term has on all of this, and yeah, it's a very slow recovery.
Okay, just on the I just want to try something on you. I think last time you came I was flooding various radical ideas like let's spell the Brazilian tax and say, well, not be confused with Brazilian wax. The issue around Bill has been talking about, one of the ideas you could do is you could target a level of the New Zealand dollar, and you could say to overseas investors, look, this is the level the New Zealand government's targeting, and if it heads over this level, we're going to print money effectively, or a different way of saying it. And you actually follow through. What's your view on this kind of policy prescription in order to put some kind of cap on the New Zealand dollar?
We don't think it would work for New Zealand. I mean, that's a variant of the Singapore sort of story, and the big differences are that in the case of Singapore, exports and imports are 200% of GDP. Here they're far less than that. In Singapore, this government has got a huge surplus, and the private sector's got huge surpluses, and we don't have those here. They've got huge intervention ability. Trade is a very big driver of the dollar in those cases, and they've got very strong capital controls on what goes in and out. And we don't think, really, in almost any of those, that New Zealand could do that. Now, what Bill's suggesting, I think, is a variant of that, which presumably would end up very inflationary in terms of printing money, and that's got a lot of distributional consequences.
So having, just to follow, so having